go.
Streaming from South Africa to the world. This is the Stonks Go Moon podcast. What just happened? We break it down so you don't have to.
Welcome everyone to the Stonks Go Moon podcast. My guest today, Eric Dugan, founder of 3D Capital Management. Eric, welcome to the pod.
Thank you for having me, Rocco.
So many retail traders out there at the moment. But a question I get a lot is, how do you go from retail, right, managing your own money, to managing someone else's money and what is referred to as institutional? You've been in the game a very long time. What is the best advice that you can give someone that's maybe thinking about that before they make any mistakes?
Well, I guess the first thing is just know that you're going to make mistakes. I mean, that's all part of the process.
Yeah.
So going from retail and trading your own money to trading institutional money or other people's money, I would say it's a process. I mean, this is truly a marathon. You know, it's not a sprint. There's lots of ups and downs. You're going to make mistakes. There's lots of conferences you can go to and people out there that are going to reach out and say that they can help you. And, you know, you're so hungry to get out there and be known and be seen. And you try, and we've been through this ourselves. You try to do everything to get the visibility, but you really have to have a game plan and understand that this is a long-term process.
Okay. How long time frame are we talking about?
Well, depending on the product you're going to launch,
Yes.
you know, for us, it was probably 3 to 5 years. You know, what we do is very different than what a lot of managers out there are doing. Our strength, our expertise is profiting from the short side.
Okay.
Right. So a lot of people are into buying dips. And if you look at correlations and how they protect themselves, I was fortunate enough to start my career with Monroe Trout, legendary Monroe Trout. Not a lot of people heard of him, Rocco, because he is long gone. But when I started in the 90s, it became very clear that you could identify the daily direction of the S&P 500. And I've said it before, and I'll continue to say it, days make up weeks, months, quarters, and years.
Yeah.
And if you knew the S&P was going down today, would you stand there and let it run you over? And for us, it's absolutely not. And how do you solve that problem? You short the market. So for us, it was a little bit probably longer of a time frame.
Okay.
Shorting in futures, if you ask a lot of people, are two very dirty words. Start with S and start with F. You know, that's not the case. If you want to be a conservative stock market investor, you actually should be able to short the market, and you should use futures.
That was my next segue into Shortside Alpha, because I know that's your sort of investment / trading strategy. And I saw you comment on a lady that I can't remember her name now, but it was on LinkedIn, and they were net long, right? Net long hedge fund. And you basically said, well, how do you protect your short side? And I guess the same is with Tiger Global. What are they down, like 58%, something 50%? And that's also like a net long hedge fund. So I guess my question is, like, you've already said the moment that you realize, Ray, great, this is like, you can short the market. This is something everyone is doing. But my question is, like, how do you go about that, turning that thought into an investment strategy?
So like I said, again, I was fortunate, I can't emphasize enough, to learn from one of the best to ever do it in Monroe Trout. He's in the New Market Wizards book that I have on my shelf.
That's a Bible. Robert van Eyden also refers to that as the Bible. Yes,
it truly is. So when I started with him, you know, he managed risk one day at a time as well. You know, you identify trends, and a lot of the CTAs and hedge funds out there are, you know, call it longer term trend followers.
Yes.
And many believe that, you know, if a market's going to trend, it's got to go 10, 20 or 30 days. You know, for us, you can't get to 30 days without passing one. And we know that the market takes the escalator up and the elevator down.
Yep, that's clear. I mean,
that's very clear.
For anyone that had any doubt of that stocks only go up, this was a wake-up call.
There's no, I mean, 2018 was a wake up call as well. From the end of 2016 to the beginning of 2018, I think we had 15 consecutive up months in the S&P, lowest level of volatility in the history of the market in 2017. And then in 2018, last week of January, first week of February, we had the fastest stock market correction in history to date. Market dropped like 11% in 3 days. Now, gold, bonds, Bitcoin, defensive stocks are likely going to go down in that. So the only way that you can actually solve that problem is to be able to short the market. So that gets back to your question. So how did it come to fruition? I was like, well, one day I was just like I told you earlier, wow, the market's going down today. I know it's going down. How am I going to profit from a falling stock market? I have to be able to short the market. We don't use options, right? We don't use, you have the whole decay and time. We short the market, or I should say, we manage risk one day at a time. So when you get a day like I referenced something in a post I just put up there, April 21st, when the market drops 2% in one day, you can take advantage of that by shorting the market that day. I think there's a lot of probably misconception out there. A lot of people, they're afraid of what they don't know. They see things like GameStop headlines, the market's rallied 300, 400, 500%. People are getting short squeezed. We don't approach the markets like that. We literally manage risk. Our systems manage risk one day at a time. So the whole process is looking at the markets in Asia, Europe, and the US, stocks, bonds, currencies, energies, and metals every single day, because I've managed every time zone, Asia, Europe, and the US, and every asset class. And the world is one big flow chart, right?
Yeah, it is.
We know this. If you looked at what happened even with COVID, the market started selling off in Asia, or COVID actually,
in Asia,
started in China, and then it spread to Europe, and then the US. So if you looked at how the global relay race works, there are statistically significant clues across the globe that can help you identify the direction of the S&P 500. And when you do it one day at a time, Rocco, you're able to, call it pick up dimes, pick up nickels along the way. And then, when you get the big sell-offs, you're able to, you have the ability to take advantage of it.
So, I mean, most people.
So, you know what, Rocco, hold on. I didn't even answer your question. The long only equity question I had on LinkedIn. That woman posted, she was an equity strategist. And I asked her, how do you profit from, the downside? When the market goes down, what do you do? And she said she wasn't a short seller. And it was a very respectable exchange, but I was just so perplexed how you could manage equity market risk without being able to short the market. Because again, if you want a conservative, smoother equity stream in the stock market, we all buy the market because it goes up. Well, the other side of the equation is you want to profit from stock market declines, you have to be able to sell it. And that, that's pretty black and white. There's no misinterpreting that.
No, I mean, if you look at this hat, right, I chose this hat for this season because if from certain angles it looks like a bull, but if I do it like this, it can also look like a bear. And this is my bull bear cap that I use. So I say, whatever the market mood is in, that is the mood that I am in. And I find it hard to understand people that are either a bull or either a bear. I just think that whatever mood the market is in, you need to put on the correct cap. 99% of people only know the market going up, right? We can say it's QE, we can say it's Fed, whatever it is. So they will buy something, hold it, and then it appreciates in value. They don't even know what hedging or shorting is. If someone comes to you today and says, listen, Eric, I want to learn more about shorting, or how do I physically sell the market? Because the concept of selling something and then making a profit off the back of that is foreign to most people.
It is. I mean, we use futures. That's the only vehicle we use. We use the E-mini S&P futures contract. There's no borrowing of shares. I understand it's hard to get your head around how do you sell something that you don't own. So with futures, you don't have to own it, right? You can short it if you think the market's going down. You can buy it if the market's going up. And to your point, whatever the market is, you're a bull, you're a bear. If you looked at Friday, we had some risk off. The market was down over 1%. Now it's up over 1%. So being able with futures, what you're able to do is to be dynamic and adapt to the daily narrative of the market.
Yes. I absolutely agree with you. Another trend that's sort of picked up with this tech sell-off, this aggressive sell-off, correction, whatever you want to call it, is extreme fear in people. And fear is an emotion, and then like all emotions, they can be sort of channeled, and they can be, you can work through it. So was there ever a point in your career, maybe at the start, where you got emotional about positions or about maybe taking a loss here or there? And how did you sort of go about dealing with that?
Well, again, because we're so different in what we do, we've actually evolved now, Rocco, where we actually offer long short programs, right? They're better together than apart, being able to buy the market and being able to sell the market, right? So a long short product, if you will. So our clients have the ability to profit from rallies and declines. But in the beginning, it was, short only. And the product was a true hedge. We would put on a short position and we would get out. The way we invest, we use price-based stops and time-based exits, which means if you're getting out according to the time of the market, that lets your winners run. If you're getting out according to a price, once you get to a certain price, you get out of the market, you cut your losses, you let your winners ride. In the very beginning, when we launched, we put our hedge on and we would let that go until the market closed, because it was a true hedge. You were long in one bucket, you're buy and hold, and then you were short, you put your hedge on over here. But because I learned from Monroe Trout, and he was the only word I can really use is legend in terms of managing risk, which is clear in the book. We knew we could do better in terms of managing the hedge. So what we did was we made adjustments to the system, because we've got the thought process here at 3D Capital: adapt, evolve, compete, or die. It's that simple. So what we did is we started managing the short positions on an intraday basis, where we would get out at a certain retracement off the low or from entry. So we were managing the downside even more, which would be better off in the long term. And that's why we've had so much success from 2011 through today. And in fact, even with COVID, right? From the March 20 low of 2020 through the all-time high in January of this year, I think the market rallied about 120%. And, and we successfully shorted and navigated that time frame, which a lot of people won't get their head around, right? How did you survive 120% rally as a short seller? Well, we all know the market goes up more than it goes down. So you don't have to be short all the time, right? That's like dead weight. You pick your spots, you identify statistically significant patterns that are logical, symmetrical, and persistent. You manage that risk. You manage the downside with the stock market itself. And over the long run, you're going to win more often. And who doesn't want to do that? I know I do, and I know our clients do.
Absolutely. Eric, thank you so much for joining me today. If there are any investors or listeners out there that sort of, this, whatever you said now appeals to them and it landed very well and they want to connect with you, where can they do that?
They can go to our website, 3dcapitalmanagement.com, LinkedIn profile, give us a call, reach out. Be glad to answer your questions.
And also connect with Eric on LinkedIn. He puts out amazing little vlogs that I personally enjoy very much. Eric, thank you so much for joining us. To our listeners, peace, love, and prosperity. We'll catch you in the next one. Cheers.